Thank you all for being here. You've heard our view of a 3-2-1 GDP world, 3% this year, 2% and 1%. You heard David Kostin's Goldman view, which is a little bit better in 2020, but roughly the same in 2019. And you heard our view that we think Fed funds could go to around 3%. And that's roughly the same as the Goldman view on that. So agree, differ. Are we right? Are we wrong? I mean, what do you think? So we'll start with Ed, and we'll just go around the panel.
Yeah, absolutely. So thank you so much. Thank you for having me. I think that we have similar views. I think that we're probably a little bit closer to Goldman than we are to you. I guess the big question is, how far along in this cycle are we? And I would agree with, I watched your presentation. I agree with all of your assessments. I think there's probably two big things where we differ and why we see GDP growth next year somewhere. Our target is 2.7%, and for 2020, 2.3%. So certainly slowing down, but not nearly as much as you.
Well, on a year-to-year basis, we're at 2.5, so we're not that different because I was using fourth quarter to fourth quarter.
Okay, fair enough.
So we're very close on 19, but you're much stronger in 20.
Yeah.
Okay.
And I think there's probably two big reasons for that. Just looking at your forecasts. Average hourly earnings tend to peak late cycle, starting around 4% or going above 4%. Average hourly earnings right now are really only at 3%. So that indicates to us that we have a little bit farther to go in the cycle. Also, S&P earnings and where they're going, we're predicting continued earnings growth. So we also see that as this cycle has a little bit longer to go. I think those are probably the two big factors that leads us to be a little bit more bullish than you. But we do see slowed growth, just not quite as much as you.
Okay. Gilda?
Certainly. The slowing, the downturn in the economy, definitely at the late cycle, very apparent. And the range could be different. That any economic forecast that I see, the ranging between 3 and 2, and then a 1% in 2020. However, the catalyst for that could be different, right? In 2018, I think the tax stimulus was very definitely very instrumental in the growth. That won't exist in 2019 and 2020. And I definitely agree with your forecast that it is definitely on the slowing trend.
Asher?
I don't think I would disagree with most of what was said. We could squabble over whether it's 2, 2.5, 2.3, 2.8. But the bottom line is we don't see a recession in the horizon, at least in the next 12 to 24 months. There is a lot of, we would call noise in the media about concerns. And my feeling is, overall, the society at large, investors, suffer from PTSD after the last crisis. So any little thing just tends to blow up the headlines. And we have to be careful with that, because I think it was 2 years ago that Janet Yellen said, expansions don't die of old age. Right. And why did she say that? Because everybody thought it was going to die. That was 2 years ago, and we're still not dead. So I think we can still see expansion, and there's really no fundamental reason to see a recession anytime soon. I mean, for all the reasons that were already expressed. GDP growth is positive, employment's improving, inflation's in check. The leading indicators are positive. So there's really no fundamental reason. Then, of course, you've got technicals. And you've got the tweets, you've got the China, you've got stuff that's going to drive the markets haywire. And we as portfolio managers have to step back and say, okay, is this a technical factor or is it fundamental? And at the end of the day, the fundamentals will always prevail. But there's a third thing that we have to be cognizant of on our side of the business is repricing. And that's what we are seeing now. the repricing of risk. And another thing to think about is after the crisis, remember what happened was what the Fed did, what central banks did, created a huge moral hazard. You know, if you were a really good investor and you were doing all your analysis and you were really thoughtful about risk, you would not have invested in a lot of those highly leveraged structures. But what happened was people who did were rewarded in a sense because they were bailed out. And so you've had that moral hazard where that crowding out of the investor and throwing out of Finance 101. Kind of like, you know, during the dot-com crisis, Ed Leamer talked about that, how each of these crises had some sort of a speculative bubble kind of irrational sense to it. And during the dot-com bubble, I remember saying, oh gosh, I'm going to have to throw out my UCLA Anderson Finance 101 textbook. Right. Because they said earnings
Evo's next to you.
Yeah, earnings don't matter. Remember that? Earnings don't matter. You know, really? Earnings don't matter. That's what they said. And so that's the sense that risk didn't matter all these years. So now we have to go back and do individuals, go back to the basics, and do an individual security selection and worry about individual risks. But we have to differentiate just risk, good old risk, from systemic risk. And I think systemic risk is what we had, and that's the PTSD I was talking about. We don't think that we are in a situation where we're going to have systemic risk. I've said a lot.
Okay. Ivo?
Well, I was teaching in 1999, and I remember how the students told me that I was so old economy and we were new economy now. And it was a really hard time to teach finance. It's improved a little bit since then. But coming back to the original question, it's a reasonable forecast, I think, and most of the people here seem to share it. We are above historical averages. We are predicting some mean reversion of growth back to the normal historical averages. So it's pretty much in line. I am a little bit more concerned, though, that when the crisis hit, the last crisis hit, it was very sudden. And I would be a little bit more worried about the uncertainty about our forecast. It's not out of the question that in a year from today, we may be sitting in another financial crisis. Now, that doesn't mean that I predict another financial crisis. It's just that the probability isn't that low, as many people seem to think. When I'm sitting around with very wealthy investors, they usually tell me things like, oh, we need a yield of X. And I am wondering, and that's the reason why we lever up like crazy. And I'm always wondering, have those people completely forgotten what happened in 2007 and 2008? So I'm actually not as optimistic and confident about you and think that everybody is overreacting. I actually think there's a reasonable chance that we're going to run into another big crisis. Historically, we've had big crises every 10, 20, 30 years. And given that our government policy has been somewhat reckless over the last year or so, it's going to come back to haunt us at some point. And I don't know whether it's next year or in 5 years. But this is going to bite us eventually.
Okay. I used to be an equity strategist. I had David Costin's job at Goldman. I did that at Solomon. And David's job is to predict the market, tell people what stocks to buy and what stocks not to buy, and so on. Now, my question to Ivo, does anybody really know, or as what the great Nobel laureate physicist Niels Bohr once said, it's difficult to predict, especially about the future?
Yes, I have lots of colleagues, some of them Nobel Prize winnings, who looked at all the academic research and held forth in academic seminars how easy it is to exploit empirical anomalies, not the overall market, but how to predict small firms, value firms, this firms, that firms. They all, not all, but many of them started firms, and I think about 2/3 to 3/4 of those firms have gone bankrupt. And my good friend Matt Spiegel used to say it's not that academics are any worse about predicting the future, it's just that when they mispredict the future, they believe much more strongly in their stuff than normal people do, so they double up and they go under at twice the rate.
Yep.
Nobody can really predict the stock market. It's really very, very hard to do. What you can do, though, is choose a proper risk level and choose portfolios that are more risky and some that are less risky. And I think that's a better way to look at the problem.
Okay. Let me follow up another question with you, Eva. What do you think is and I'll ask the rest of the panel as well, what do you think is the long-run rate of return, forgetting about what the stock market's going to do next month or next year, a long-run, reasonable estimate for a long-run rate of return for, say, the S&P 500 or a broad index of U.S. equities?
It's an incredibly difficult question. People have looked at this for a very long time, both with long-term predictor variables. We have historical data. We can look at historical data and see how it was. And you do this in the US and you come out with numbers that are 6-7%, which look incredibly high to us.
And that's real or nominal? 6 or 7%?
5 to 6 real,
Okay.
7 to 8 nominal. It
Okay.
also depends on whether you do geometric versus arithmetic
Right.
rates of returns. That has a huge influence in these kinds of calculations. Most people just look at historical rates and predict that it's going to go on like this. But let me warn you, if you do this, if you were here many, many years ago when I was teaching, Japan at some point had its Nikkei above 20,000, 30,000?
38,000.
38,000. And today they are at?
21, something like
21.
that? And they were as low as 8?
This is like 25 years later. So
Yeah.
we have not experienced that, but there is no law of physics that guarantees that this couldn't happen to us. Just looking at the history, if you had stood there where it was 38,000, you would have said, wow, the Japanese stock market has to have average rates of returns of 10, 12% per year. And it didn't. It had negative rates of return per year. There's no law of nature that says that this can't happen to us. So just be careful about this. If you ask me what's a reasonable forecast, it shouldn't be negative. It also shouldn't be 5, 6, 7%. 2 to 3%. Geometric nominal is not a bad forecast. That makes it 1 to 2%. That would be a reasonable expectation. You ask most investors on the street or your taxi cab driver, and they will tell you it's much, much higher than that, which should make you worry a little bit.
Okay, that sounds low because cash is 2% right now. So why?
Sorry, I've been quoting equity premium. So it's 1% above what cash
Okay,
does.
fine. That's okay.
Real,
Let's be clear. Asha, before you had a heart attack when you heard that.
No, I just wanted to, I'll answer that, but I also wanted to follow up a little bit on this crisis story. But the one way to think about, I think, equity returns is it has to follow GDP in some way. So if you're talking about GDP at 2% and inflation around 2%, so we're talking 4 or 5%. So anything over that, we still see it. It could be because of various other global factors, and but on average, it should be around there. But what I wanted to say about the crisis, Ivo, is that I agree with you. It's really impossible to forecast. But I have to say tell one story, if I may, a quick story. In 2007, and the reason I say it is because in all these conversations, what we're forgetting about is a $100 trillion market, which is called the bond market. Mm-hmm. And we've talked a lot about equities, and we keep talking about the S&P. The Wilshire 5000 has only 3,600 or so stocks in it. So the stock market's shrinking, actually. We've got a lot more private companies. But the bond market is 100 trillion. The stock market globally is about 60-some trillion. So we need to really look at the bond market to give us clues. So in 2007, as you mentioned, I chair the Best Execution Committee at Payden & Regal. And I was in my office, and I was looking at my Bloomberg, and the stock market was up. The Dow was up 400 points. I remember that day very well. It was up 400 points. The bond market looked reasonable. Nothing to write home about except that it was a fantastic day for stocks. I walk out of my office to meet with some other people who were coming to the meeting. And that's two guys, one who heads up our structured product team and one who heads up our asset-backed securities team. And they were walking towards me, and they looked like they'd seen a ghost.
Right.
And I said, what? What's wrong? And they said, oh, it's a bloodbath out there.
Yeah.
It's horrible. This is 2007.
Right.
And I said, what do you mean? They said, oh, it's just the market's just... I said, what are you talking about? I just came out and looked at Bloomberg. There was nothing on any of the usual bellwethers. And they said, oh, no, you have to look at the ABX index. I said,
right.
What is that? And they said, where do I find it? Tell me the ticker. I want to look at it. And they said, no, you can't even see it on Bloomberg. It's you have to get onto market.com. I have to get on the internet to look at we pay a ton of money to Bloomberg, and I can't see that on Bloomberg. And I pull this up, and the ABX index had fallen off a cliff. And this was on the heels of a lot of conversation we were having internally about the amount of leverage in the system. And this had been going on since 2006. We were very concerned about the leverage in the system, in the structured product, the irrationality of it, about people's maids getting $1 million homes or $700,000 homes, the ninja loans, the negative amortization loans. All of those things were of concern to us, and we avoided most of those things. And here there was that canary in the coal mine. Right. And we went in, and we had a investment policy meeting, and we started to pare back risk at that point. And we didn't have a lot of subprime mortgages, but those that we did, we started to pare back. And anything that the ninja loan type stuff, even a hint of it, we started to pare back. So if you really want to look at a prediction of the stock market, ask a bond manager.
I agree with that. Okay, Gilda, do you have a comment on the market, or is this outside of your...
That's outside of my
Okay.
forte.
Yeah,
What are you telling your clients, long run rate of return, when you sit down?
Oh.
Long run rate of return for stocks. What do you tell them? Somebody walks in and says...
Equity premium, I would put 4 to 5%, not 1%.
Okay.
But I want to actually piggyback off of what was just said there. You talked about systemic risk in the bond market, and tell me if I'm going off base here. But one of the things you talked about in your presentation was the high yield market.
That's going to be the next question.
Oh,
so
okay. Then I'll let you ask that question.
Okay.
Go ahead.
All right. So my question is my concern is if you look around the world, where's the excess? Where's the excess in credit? And you could, outside of my bailiwick, you could say Italian bonds. It's not in my bailiwick, so I'm way over my skis when I talk about that. But you can say, arguably, that's an accident waiting to happen, which could upset the euro and create all kinds of systemic risk. But what I look at is the corporate bond sector, and I see what's going on in terms of using cash to finance deals. Now, normally Evo would say when you buy a company for cash, it's much better than when you buy for stock. That's traditional finance theory would say, but most of the deals been done with cash. So AT&T bought DirecTV and bought Time Warner and borrowed $190 billion. And then you have CVS, Aetna, and you have a whole series of these merger transactions all done. Bayer buying the pit that Monsanto was turning out to be and borrowed money to buy that. So you have all this leverage being built up in the corporate system. You have Janet Yellen talking about issues in the leveraged loan market. And you go along until October, you couldn't tell by looking at high yield spreads. They were 3%, in round numbers. They recently jumped to 4%, as I had my slide up 100 basis points. So my question is am I right that this looks like the excess? It doesn't look like it's mortgages. It doesn't look like it's consumer credit. It may be some international bonds, but that's over my skis. But it looks like domestic corporate credit. And the thing is, as David was saying, one of the things that have been fueling the stock markets is firms have been leveraging up to buy back stock, which adds to that. So that's my question is how do you look at the risk coming from the corporate bond market, because the thing is the bond market will normally smell the problem, which I agree with you, Asha, is one of the reasons why you looked in September. If you're looking at the bond market when stocks hit their peak, there was no warning. From the bond geeks were late in terms of that. The bond geeks should have been there earlier, but they weren't. So my question is, how do you look at credit risk in the system?
So I think this is probably one of the most interesting things to have discussed today that I don't think enough people are talking about. And you talked about the high yield market, but the big kind of warning that I want to mention to everyone today, and you should all take a look at your portfolios when you go home, is the investment grade corporate market, specifically triple Bs.
Right.
The triple B investment grade market, people think of, the vast majority of people think of as this is my safe money. This is investment grade bonds. The triple B bond market was something like $700 billion in 2007, 2008, and 1/3 of the investment grade landscape. It is currently close to $3 trillion, and it represents 50%, and in some actually things I said it's edged above 50% of the overall investment grade bond market. So I think we have a lot of people right now that say, okay, whether it's 20%, 30%, 50%, this is my safe money, this is my safe bucket, they put it in a mutual fund, it's investment grade corporate bonds, and I think that there is a serious problem there. You see increased leverage like you talked about, and if all of a sudden these triple B bonds start becoming what's known as fallen angels, you could have a huge rout in the investment grade bond market, and that would have huge implications also in the high yield market. And you mentioned ETFs before. What happens when people who have invested in these mutual funds or these ETFs, when they think this is their safe bucket, when actually 50% of their safe money is not really safe? What would that do to the financial markets? And you said that there's no systemic risk, or you don't see any systemic risk. I personally think that there is systemic risk, specifically in the triple B market, because of the way people are viewing it. They see it as safe money, and I don't think it is. So specifically what we're doing at Wells Fargo within the private bank and our fixed income strategy team, our FIST, is we're not only shortening duration in bonds, but we are also moving up in credit quality. So when we're building a taxable account, usually 50% of that is in treasuries, and then we're really looking more at A-rated bonds and a really minimal exposure to triple Bs. So if we want to talk about systemic risk, I think that's where it could be. When will that become a problem? I don't know, and I think that's one of the issues. The longer we don't have a recession and the longer earnings continue to go up, I think the longer this can exacerbate itself, which means when we do have a recession, the crisis could be much worse.
Gilda, you're sitting as a
Definitely.
risk officer in a bank,
Yeah.
and you're looking at like mortgages, commercial real estate, and corporate. How are you approaching, the risk profile for the Bank of California?
Yeah, actually, two different sides of the equation, right? Speaking of the highly leveraged loans to corporations, we've been looking at the widening of the credit spread, and that certainly represents a huge risk for us, for banking industry, in terms of de-risking the balance sheet. We have certainly curtailed our lending to leveraged corporations and the high level of debts that we're seeing. So that's definitely a risk to the credit. Although right now the credit picture is still very strong, both on the consumer side as well as the business side. However, we're seeing the telltale signs of that. On the consumer side and the retail side, mortgages, we also have a very strong credit quality right now. However, a couple of things that could be on the horizon that we feel that represents risk to us is one is an increase in the level of cash out refinances, for instance. We see an increase in that, and even the mortgage insurance companies are worried about that trend, as well as perhaps the payment shock due to rising interest rates and all the IO loans that have been made out there. So that could be definitely not to the magnitude of what we experienced in the last credit crisis, but there's always debate right now as whether this elongated credit cycle, whether we're in the 7th inning or a 9th inning, but definitely something that we all agree in the banking industry is that there is a downturn in the credit cycle coming, even though right now when you look at the losses for the 6-7 years has been very, very low. And in fact, there are a lot of recoveries, but there are systemic risks in the system that could actually come back to bite us.
I'm going to follow up. Chairman Powell noted the elevated prices of commercial real estate in his talk at the New York Economic Club. How are you looking at lending to commercial real estate?
Commercial real estate, in terms of, we look at it in two different segments, really. Multifamily being one of the strongest segments for really all banks. It's been performing extremely well in terms of credit. However, the other sectors of commercial real estate, interestingly enough, some of them have been impacted by technology. Think about hotel industry, right? Airbnb, which is a technology company, impacting the hotel properties. And therefore, we as a bank would curtail on that business. The other one to think about is Amazon impacting the retail centers. So there are pockets of risks that we're looking at as far as commercial real estate. However, we don't see any overbuilding like we did back in the last recession. We are not seeing abundance of office buildings being built or any of those types of risks, but definitely slowing in the values and the downturn in the values. Nothing like 30-40% drop like we saw before, but definitely a downturn.
Okay, Asha?
So I want to be clear. Obviously, we do think risk is back because the daddy is no longer bailing people out anymore, or what I like to call crack cocaine, no more. We're suffering from some withdrawal. So, but I do want to talk about triple Bs and spreads widening and all of that. So we've had some extraordinary things happen this year, where with the tax reform, we had a tremendous amount of about 300 to 500 billion in repatriation of bonds, and many of them are clients bringing offshore money back into the US and spending on share buybacks or higher dividends. So that has been a headwind to corporate spreads. So we saw that particularly in the early part of the year. And they're still doing it. I mean, it's still happening. So that's going to be a bit of a headwind. On the triple B side, what we've seen, you're absolutely right, 35% or so of triple Bs in 08, 50% of the index now. So that is definitely something you see in headlines, and you see these huge dollars that are thrown out there in terms of how much leverage there is. But the way we look at it, it's much more nuanced than that, because you have to go and look at and parse out where this leverage is and where it's coming from and why. And some of that has come from downgrading of banks that happened after the crisis, and they were downgraded because there's no longer the bailout put, or whatever you want to call it, anymore. That's the expectation by rating agencies now. They said, okay, all this time you banks have been too big to fail, and you've had this additional protection, so you got a little bump up in your rating, and now you no longer have it because of these new regulations, Dodd-Frank and all of that. They now have living wills and things like that. So that has been caused them to get downgraded, and some of them drifted into the triple B space. So that increased. But other factors too, lower interest rates. Lower interest rates has obviously been a big incentive for managers, company management to issue debt. And when they've found it's actually very advantageous to have a triple B rating, because you got a lot more flexibility. And that's the feedback we get from management. When we do our corporate analysis, that's what we get. So if you look into the last 25 years, statistically, 9% of BBB minus companies actually got upgraded, whereas only per year, and 5% were downgraded below investment grade, because going below investment grade is extremely costly for a company. So management will move heaven and earth to maintain that BBB rating. That being said, not everybody is a good actor, good player, so you've got to do your homework, you've got to do the analysis. So it's not that simple right now like it used to be. So in 2009, we just ramped up our corporate allocations, for example, just across the board. We loved the sector, we just went for it. And then over the years, we've had to be much more nuanced, and now it's just a security selection game.
Okay.
From a systemic risk, though, I do want to emphasize something, because the risk, what I mean by systemic risk is the domino effect. I mean, it was an existential threat. Our financial system was going to collapse. And that's not what we're seeing now. And why was it going to collapse? Because the amount of leverage in the system. And what kind of leverage was it? It wasn't this sort of leverage where it was 1.5 times in the IG space, investment grade space in 2008, and now it's 2.5 times EBITDA. It's not that kind of leverage. It was huge derivatives leverage. Right. And so that's something we don't see now. There's a lot of restrictions, and banks used to be 20 to 30 times levered. Now they're, by regulation, 8 times levered. Right. So that domino effect doesn't seem to be there right now.
Okay. Ivo, do you have a comment on credit spreads?
Not very much, but this sounds quite true. It is very hard to measure where the risk actually is, because it is so often hedged with various derivatives that in the economy nobody really knows where the risk sits.
Okay. All right. Let me ask a question on equity, on the equity markets. One of the things that have become very popular of late is ESG investing. And ESG is sort of investing with your values. So let's call it environmental, social, and governance. And there's been a whole bunch of cash flowed into funds that pretend to be ESG. Now, ESG sometimes is the mind of the beholder, because what I think is socially good, somebody else would think is socially horrible, and vice versa. So the question is are you involved in this space? Does this space make investing sense, as opposed to, say, just investing for the highest return for the lowest risk? And as an example, at CalPERS, which has a whole ESG program, one of the employee members of the board, they kicked out a board member who was very pro-ESG, and they put in somebody who was we just want to make money because we want to make sure our pension is going to be there. So my question is what are you seeing in that kind of space, and does it make sense for an investor from a risk-return basis, as opposed to, well, it's forgetting about the feel-good aspect associated with it? So do you want to go?
Yes, absolutely. So Wells Fargo has actually invested quite a bit into what we call the social impact investing space. ESG is one of the big categories that we put on it. I guess just backing up for a second, traditionally, social responsible investing has been a negative screen. So for instance, if a church wanted to invest, they would say, all right, we want to invest, but we don't want to invest in weapons manufacturers, alcohol, gaming, things like that. The evolution now has turned ESG, which is what we would consider to be a positive screen. So analysts going out there and looking for companies, not necessarily taking out companies that are doing bad things, but looking for companies that are trying to take active measurements in what they're doing. So companies that acknowledge that climate change is a thing, that they do have an impact on the environment. Social, are companies actually investing into the communities that they're operating in? And governance, do they have good corporate governance? So why are we doing this? Just by a show of hands, who here is 40 or under? Right, so a decent amount of people in the audience. So when I'm talking to clients and potential clients, ESG almost always comes up with younger clients. For clients that have inherited money, this is something that they are taking a lot more seriously than older clients. They have are always taking active approaches and ask me about it. But also, completely aside from how they invest their money, when you look at trends of how millennials and the companies that they are attracted to, a young person is going to be much more attracted to go to work for a company that acknowledges climate change is a thing and is doing things within their company to do it. Same thing with investing money into the community. So if you're going to look for companies, if you don't care about ESG at all and you're interested in good returns, you should also be looking at this, because if you want to look at where young people are choosing to, the companies that they're choosing to go work for, I think it is an important thing to take a look at.
Asha?
Yes, it's a very important. I agree with everything that's said. We are getting, most of our clients are institutional, and so we are getting a lot of questions about ESG and RFPs that are ESG compliant, especially from Europe. Actually started in Europe, and then also some public funds as well, and really across the board. But ESG is one of those things. It's really hard to define. And the Department of Labor has actually said that you've got to be careful with that, to your point, that you've got to make sure that you're doing right by the beneficiaries and that you're not compromising return. So that's why as managers we have to be very careful that we don't impose our own values onto our portfolio. So we rely on our clients to give us that. But at the same time, as managers, so ESG, G is the governance, and governance is a huge part of good work, corporate research anyway. So we embed it and incorporate it into our portfolio, into our research. But in terms of actual ESG, there are also now there's SRI, PRI, there's SDG, there's a whole alphabet soup of types of MRI is another one, mission-related investing. So we accommodate our clients. Sometimes it's by exclusion and sometimes by inclusion. Okay. So SRI, for instance, is socially responsible investing, which means you avoid whatever, like if it's fossil fuels or firearms, you can actually identify certain industries and avoid them. And then there's impact investing, where you're actually seeking out companies that are green or doing good. So it's still in an evolving phase, but I can say that over the last just even 3 to 5 years, there have been incredible tools, measurement tools now that have been developed. Like MSCI has a scoring system for each of the companies, which is very helpful. And then there's SASB, the Sustainability Accounting Standards Board, founded by Mike Bloomberg and a few others. And so that's very helpful too. They're actually trying to put some fences around what that means.
Okay. Ivo, do you have any comments on this?
For the most part, individual investors cannot change what corporations do. The market is just too elastic. For any investor that goes out, somebody else is going to be willing to come in. Even if you divest of billions of dollars in the markets today, it will take a few microseconds before somebody else steps up to hold it. And we've studied the impact of divestments from South Africa. Actually, I and some co-authors did, which was a very coordinated boycott with all sorts of legal ramifications left and right. It was more an embargo than a boycott, and still we couldn't find any economic evidence that it actually did something. So it's fine if clients want to do this and you just follow your clients. Fortunately, it doesn't cost too much to do it, but there's also not a great impact on the social ills of this world. So just don't live in the illusion that that's the way you can change the world.
And is that going to change? Does that have any impact on risk and return?
Pardon?
Does it have any impact on risk and return? Or
very little. There seems to be an administrative cost to it, which seems to be the biggest part of it. Other than that, it's of second order importance.
Okay. All right. Do we have any questions for the panel?
Would you care to speak about municipal bonds?
Yeah, I'll say I have similar views as I was talking about with the triple B market. I think that municipal bonds, we talked about index investing. I think that if you're going to be investing in municipal bonds, you absolutely should not be investing in any sort of index or just thinking of them as a whole. You really need to be taking a hard look at any municipality, any state, the specific bond, and edge on the side of higher credit quality. One of the things that we do not invest in are the taxable muni bonds, so pension obligation bonds. Those have some pretty significant legal, political, financial risks. But if you're looking at general obligation bonds, you really need to take a hard look at each individual one. So active management, good fundamental analysis, that's the way to be doing it.
Same here. That pension issue is something that we watch very carefully. And some states do a much better job than others. And it's really, we're looking at how the pension liabilities will affect the budget and what is it crowding out. And yet there's some hope on the horizon with some of the states that are doing a decent job. I mean, I would avoid states like Illinois and New Jersey that still are not quite there.
Let me make a comment on that. I was part of a team that gave a presentation to the New Mexico Public Employee Retirement Association, which is the same thing as CalPERS here. And they have, using the government loosey-goosey accounting, have $14 billion in assets and $20 billion in unfunded in liabilities. So they're 70% funded. They're short $6 billion. And their return, they're assuming a 7.25% return, which is, even though you would say that's like, to get to these numbers, you would say that's a touch on the aggressive side, for all their assets. And before we get smug in California, the funding ratios of STRS and PERS are the same. They're about 70% as well. So the unfunded liability of CalSTRS and CalPERS is $180 billion right now. And that sort of dwarfs the $15 billion surplus that Gavin Newsom is going to inherit. So my sense in looking at any kind of muni credit, it's these off-balance sheet pension liabilities, because what's driving government spending is there's two big drivers of government spending, and that really hurts UCLA. It hurts public schools. It hurts universities. The two big drivers of government spending is public employee pensions and Medicaid, Medi-Cal, and everything else is secondary to those two items.
I was about to say only 30% unfunded. That's not bad.
But that's using discount rates of the same as the earning rate, as you know, and not what private plans use. Which private plan would use called 3 or 4% discount rate. Public funds are discounting forward liabilities at the same rate they're earning at.
Let me repeat this. Only 30%?
Yeah, right.
I mean, there is funds out there, public pension funds, that are in far worse shape.
Oh, Kentucky, New Jersey.
Entire states.
Oh, Kentucky, New Jersey,
Illinois,
everything. Total meltdown. Completely unsustainable. Why don't we give the panel a big round of applause.